Most people have a pile of assets, but almost none of them have a system that they work together in. Now, that's the entire difference between people who live off their money forever and people who eventually run out. Now, I use 4 steps to turn any pile of assets into cash flow that never stops. And it's not a strategy, it's an actual system that has rules. So I want to show you all 4 steps and how you can install all of them for yourself. So let's go. All right, so what am I talking about with a pile of assets and a system? You see, most people just buy a bunch of assets, and that may be whatever they see on Twitter or they see on YouTube or they're on Reddit boards or whatever, and they end up with a bunch of piles of assets, but not a system. What's the difference? A system is something that's intentionally built to achieve a specific outcome, but most people don't even know the outcome that they want. And so, for example, is it that I need a certain amount of money? Let's say I want 5 million in, 5 years? Is it that I need, 10 million in 3 years? Like, what is even my goal? What am I trying to achieve? And then how do I organize a system to achieve that goal? You see, what people do is they buy a pile of assets without understanding what they mean. I was going through one of my coaching calls yesterday and I had this exact problem come up. And the person asked me, hey, I've bought a bunch of assets. They're currently down about 35%, and I don't feel like I'm going to get to my goal. So first of all, what is the goal? What is the time frame? Well, their time frame was about 5 years. Okay, so first of all, why are you looking at your portfolio performance over 6 months when your time frame is 5 years, first of all? But let's dive in deeper and understand what are the pile of assets that you own. Now, they rattled off some assets. A couple of them, one was STRC. I talk about that quite often. One was called SATA. Okay, but see, both of those assets are for earning yield. They pay yield, but there's no cap appreciation, meaning they're not going to go up in value. So if you're looking to make money, their goal was they wanted to make enough money to build onto their practice. So they wanted to get something that would go up in value, have capital appreciation. But these 2 assets aren't going to go up. They have no capital appreciation. Okay, then they had a couple other assets. There was like XXI. I think one was STRK. Maybe the other one was like MSTR. Okay, these are highly volatile assets. These are sort of like micro cap stocks, highly volatile, that are going to take a long time to go up in value. So they had these assets that actually contradict what these assets are. How do these even work together? If all I looked at is the assets, I'd have no idea how this is working to help you get your ultimate goal. So what we need to do is, first of all, identify what are we trying to do, first of all, over what time frame, and only then can we turn this random pile of assets into a system. All right, so let me show you how we build a wealth operating system. Again, a system purposely designed to achieve the ultimate outcome that you want. So the first thing is understanding what the outcome is that you want. We're going to skip past that, assume you already know that. And there's 4 parts to building out the system. The first is the X-ray, not just a pile of assets, but what are they specifically? I need to know what every single asset is, what the purpose of that asset is, what my goal is. I'll walk through that in a second. Then we have to build out the treasury with 4 liquidity layers. Now, most people look at some of this stuff and they think investing is risky, or doing some of this type of investing strategy sounds risky. Well, they are, but we build a treasury to mitigate the risk. Okay, then we use leverage. We don't want to borrow, we don't sell. We never want to stop our assets from compounding. So we want to, just like a central bank, we buy assets and we issue credit. And then ultimately, velocity is how fast, how many times we can multiply our growth. Those are the 4 steps. Let me walk you through them. All right, so the first thing we want to do is we want to turn that pile of assets, those random assets that you bought, or whatever you may have inside your wrappers. I call those the 401ks, the IRAs. Like, what do you even own? And I run it through 4 different things. So number 1, obviously I can't design a system if I don't know what tools I have in the toolbox. So number 1, what assets are good assets that can be used for collateral? All right, so the purpose of building a system is, like I said, a central bank where I can acquire assets, I build assets, I never sell the assets, and I can get liquidity against those assets by issuing credit. We're in a debt-based monetary system. You can go to the bank and get a loan. They'll give you $1 million or $2 million or $5 million or $10 million. Do you know what determines how much money they'll give you for free? Well, not for free, but for the interest rate, your collateral. So what assets do I have that could be collateralized? And those could be stocks, equities. It could be real estate. It could be, Bitcoin. All different types of assets could be collateral assets. So which ones could be used in that way? Then I have productive assets. So these are assets that pay me while I hold on to them. Okay, so this could be different types of assets. These could be like income funds that I invest into. It could be real estate assets that I own. And you might say, but wait a minute, you just said that real estate was a collateral asset, but why did I buy it? I could use a hammer to put a hole in the wall instead of a drill. What's the purpose so that I'm using this tool for? So then I have productive assets. So which of my assets that I have are productive assets? Then what assets do I have that are considered lifestyle assets? What do I mean by lifestyle assets? So like if I have a boat and my boat could be worth 100,000 or a million or whatever, 100 million or whatever it is, and that would sit on my balance sheet and it would show as an asset, right? The boat is worth some money. The car is worth some money, but it's not a productive asset. It's not a collateral asset. It's a lifestyle asset. I use the boat. It's a depreciating asset. And so certainly it's going to show up on my balance sheet, but I'm not going to count it as something I can build my wealth system around. And then finally, we have deadweight assets. Deadweight assets doesn't necessarily mean they're bad. What it means is that I can't really do much with them. So this could be like, maybe I bought a piece of land over in Bali, for example. I was over there on vacation. I bought a lot. Well, it doesn't really do me any good. I can't really do anything with it. I can't use it as collateral. It's not productive. It's just sort of dead weight. Some of this could also be maybe I have, money in the private equity deals or venture capital deals. And so while it shows up on my balance sheet, I can't use it. Because the first thing is, if I'm going to build a system to achieve an outcome, I have to understand what I have available to actually build with. Okay, now the next part is what we call the treasury doctrine of the 4 layers. If you have a business, and hopefully it's in a corporation, an LLC, a C Corp or whatever, right? You have corporate rules around what you can and can't do. Even if you privately own it, you're still supposed to keep your meeting minutes and things like that. Of course, as you get into hedge funds, like I'm a partner at a leading Bitcoin venture fund, we have rules of what we can invest in, what we can't invest into, how much risk we can take, how we hedge assets. We have rules. And so if you run a treasury, your own personal assets, what are the rules that you defined to limit the risk? And let me say that again, to limit the risk. You see, most investors just think about how much they can make. Professional investors think about mitigating or limiting the downside that they have. And so that's what the treasury doctrine does for us. And there's 4 layers of what we call risk mitigation. Now, Warren Buffett says the single most important rule with investing is don't lose money. And that's not always possible. We're going to lose some money. We're going to break some eggs as we do this, but we want to mitigate the amount of risk. And we do this in 4 ways. Let me give you just an analogy real quickly. I use Michael Saylor as an example of this. So Michael Saylor had a company called MicroStrategy. MicroStrategy sold business intelligence software. And he competed against the major companies, the Salesforces, the Microsofts in the world. And he found that after 2 decades, he couldn't really grow the business anymore. He was kind of stuck. He couldn't really compete against them. He's talked about, he went around the world 10 times, hired people, fired people, bought businesses, sold businesses, launched new business lines, and he really couldn't grow the valuation of the business past about $2 billion. So he changed the strategy, pun intended. He changed the name of the company from MicroStrategy to Strategy. And instead of trying to grow the income or the revenue of the business, he started to build the assets of the business, build the treasury. Within 5 years, he took a business that he couldn't grow and took it from $2 billion to $60 billion. Now, it sounds risky, right? A lot of people say, well, Bitcoin's price is down. Michael Saylor's going to be liquidated. He's going to get margin called. Look how much risk he took to build that wealth, and he could lose it all. Well, not really, because Michael Saylor's smart and he understands what treasury doctrine is. We can do the same thing, and so I'll show you what he's doing. Number 1, we need to have cash flow. So hopefully you have a job, you have a business, you have something that brings in cash flow. And then layer 1 is your operating income. Now, MicroStrategy or now Strategy has income. They have operating income. They still sell software. They still have revenues that come in. So you need income coming in, and this is going to cover all the debt obligations. It's going to cover your living expenses, right? All of those things. Then below that, I have layer 2, which is my cash equivalents. So it's not cash, but it's cash equivalents. It's things that aren't going to be volatile. They're not going up and down in value, and I can turn them into cash reasonably quick. That could be money market accounts. It could be treasury bills, things like that. And so what happens is if I run out of my layer 1 cash, I lose my job, my business suffers, something happens, my debt expenses go up, and I can no longer cover them from my layer 1 cash, then I tap into layer 2, cash equivalents. Now let's see what Michael Saylor's doing with Strategy. He has been raising cash. He went from $1 billion to $2 billion, and as of a few days ago, he reported he has $3.6 billion in cash. Now, not cash equivalents. It's probably sitting in treasury bills, things like that. Why did he build up $3.6 billion of cash equivalents? It's so he can continue to cover all of these expenses and continue to push harder on the rest of his wealth ecosystem. Then he has collateral liquidity. So if he needs additional money, he blows past this, he now has collateral liquidity. Now remember, we looked at our balance sheet x-ray and we understood what assets are collateral. So collateral liquidity, he has common stock. So he has MSTR that he can sell at the market. He can borrow against the stock if he needs to. He also has access to more credit lines, whether he wants to do convertible debt or whatever. And he's got the Bitcoin that he can also issue credit against as well. So if he runs out of this, then he can tap into layer 3. And then if all else fails, he burns through all 3 of those. At the end of the day, you have your core compounding assets. So he has the Bitcoin that he could start to sell off if he needs to. And you have assets that you could tap into if you need to. These 4 things is what allowed him to scale from 2 billion to 60 billion and not face liquidation, even though the market's pulled back 50, 60%, his stock's down 80%. And so if we want to build a treasury and if we want to build wealth, we need to make sure that we've mitigated the risk first with a structure like this. All right, now real quick, there's a QR code on the screen right now. I'll put a link down in the description down below. But if you want to see how these strategies actually apply to your own specific situation, then my team would love to walk through your numbers with you and help you build what we call a personalized wealth operating system. So go ahead, click on the link down below or scan this QR code that's on the screen right now, and then come right back because we've still got more important parts ahead. Now, another piece of this, there's more, but another piece is what we call the velocity engine, the wealth velocity engine. And just real quick so you can understand what this means, it uses a term that the government uses to measure the health and the growth of the economy, GDP. So they measure how fast $1 moves through the economy. So if I give $1 to my baker for lunch and he gives the $1 to his worker and the $1 goes to the gas station and buys gas and the gas station buys supplies and the supply person buys new tires for his truck, we now have $5 of economic activity or growth, but there was only $1 put in. So the velocity is how many assets can I control with one single dollar? If I can go to 2, to 4, to 8, to 10, to 12, you can see how fast the velocity picks up, just like the government tracks that. And so what we want to do is we want to build a flywheel to get this velocity going. And we start with income. Now, we need to take income and put that into assets. Now, what we want to do is if we would build a tax layer, I skip past that, we build a tax layer so we can reclaim some, most of, if not all of the income taxes we'd pay, we can put that into assets instead. That's why it says all of it. So if we can put our income and it goes into our treasury into assets. All right, so now we're taking the income that we're making, hopefully, like I said, we're keeping a lot more of it, and we want to make sure we're putting it into our treasury first. We went through those 4 layers of liquidity because we want to make sure all of those are full. If those aren't full, then we're not able to go take the next step, which is what we want, right? Michael Saylor can't continue to take on more debt, can't continue to make those payments without building up that cash liquidity layer first to $3.6 billion. That $3.6 billion is what allows him to go do this. Another example is I'm a surfer. I live in Southern California right now. The waves have been massive. I saw over the weekend, LA County had to rescue over 2,000 people from the water. It's crazy. But my friends and I, we're all running out there and surfing in the waves. Now, the difference is that I've done risk mitigation. I know how to swim. I've taken my surfboard with me. I can understand the currents, and so I can time that. Now, my kids are also very experienced like I am. They wanted to go swimming, and I told them, hey, when you go down to the beach, don't go out in the water unless you have your fins with you, though. So even though they're very experienced, they know the ocean, they know the currents, they know how to surf, they know how to swim very well, they still need to take their fins with them. Why? Because even though they're experienced, there's still a little bit of risk out there, and so they want to mitigate it by taking their fins out there with them. That's how we don't die when 2,000 people are getting rescued. And this is the same thing. The fins help us go have fun in the waves. The board helps me have fun in the waves. The treasury, filling up these layers, is what allows me to build this wealth system so I can scale wealth rapidly without blowing myself up. As Warren Buffett would say, don't lose money. Okay, then once my treasury is full, then I start buying the assets. Now, the assets I buy, as we talked about, are not a random collection of assets. I buy them by rules, not by mood, not by whatever's being talked about on Twitter, X, Reddit, whatever, but I buy specific assets that can work together to help me get the blended return I need by the time I need it. Okay, then I use my assets like a central bank. I never sell the assets. Instead, I issue credit against the assets to get me liquidity. Liquidity for what? Liquidity for one, for my lifestyle. So now my lifestyle is funded by my assets. Also, the liquidity buys me more assets. And now I start having a wealth flywheel that goes faster and faster. My assets become collateral. The collateral provides liquidity. The liquidity buys me more assets. My asset base grows. My new, bigger asset base provides me more collateral for more liquidity for more assets. And I continue to grow this faster and faster and faster. And I can already hear the comments coming in, but Mark, that sounds like you're taking a lot of risk. Yeah, but I wear my fins when I go in the water. We continue to fill up our treasury, just like Michael Saylor did, with not $3.6 billion, but enough money to mitigate the risk of our growing velocity flywheel. Okay, now most people will understand these 4 steps, but they'll never build the system. Because the real challenge is knowing how much cash to hold in these layers, right? Which assets should I actually use as collateral? And boy, if I could save some taxes, that'd be great, but where do they fit in? And how should the money move every single month? So how do we actually do this? Now, if you want to know, in the next video, I'm going to show you the complete wealth operating system and how every piece works together. So click on the video on the screen right now, and I'll see you over there.